Hello, Matthew Copley here, President and CEO of Copley Financial Group, and today we're going to do a market update. There's been a lot that has happened in the last month since the last market update. A huge jump in gold prices followed by a big crash. Big manipulation in the markets by the Federal Reserve. We're going to talk about economic data, what's going on in the markets, what we're seeing as far as the markets going up or down, and we're going to talk about some new opportunities that we think are going to be very, very good for 2026, some new investments we might take a look at, and so it's all coming up right here on our market update. So the stock market is really at a pivot point here. If you look at the charts, it's very interesting. We have seen a consolidation in the S&P 500, and really it's a 50-50. Does it continue to go higher or does it break down? And if you look at the economic data, things look really, really good. Unemployment is down. Unemployment claims are at multi-decade lows. If we look at the trade deficits, very, very good. If you look at the Trump putting together a deal so the government doesn't shut down, I thought that was pretty positive for the markets. So we're seeing a lot of positive economic data in the markets. But on the flip side of that is valuations are still very, very high. If you look at standard CAPE ratios, PE ratios, PEG ratios, the market is expensive. So the question becomes, do people sell because the market's just too expensive, or do people keep buying because the economic data looks pretty darn good? And right now we're at that 50-50 pivot point. It can go either direction. We're going to share with you the ways that we're taking a look at this and how we can participate if the market keeps going up, but also how we can protect ourselves if the market does drop from here. Tell us what you think. Put what you think in the comments below. Do you think the market is going to go up from here or down from here? I think we need to be prepared for both. So, of course, the big news is the Federal Reserve Chairman has been nominated, Kevin Warsh, and this has created big news among the financial markets, and we've seen some reaction from the markets on this. And, of course, the media has been spinning this as, this is a Federal Reserve that's no longer going to be independent, and that Kevin Warsh is essentially going to do whatever Trump wants. And I don't think that that's true at all. In fact, I think Kevin Warsh is pretty clearly a budget hawk. He's someone who I think is going to be extremely independent. And when we talk about independence of the Fed, I think that that's a little bit of a misnomer itself. I mean, the Fed has never been independent. And I know they like to pretend like they're independent, but if you go back through history, the Fed has always been political. You can go back and look at when George W. Bush was president. Alan Greenspan later said, well, I couldn't say that because I didn't want to go against the administration, right? He said it after he left office. And of course, the Federal Reserve, if we look at when it first was created, the Treasury Secretary actually sat on the board for years. It was part of the whole process. And so there has never been an independence. In fact, in the 1960s, there's a famous story. Lyndon Johnson was very upset with Bill Martin, the Treasury Secretary, or the Federal Reserve Chairman at the time, and he called him to the White House and said, he was very upset that he wasn't lowering interest rates. They wanted to lower taxes and he wanted lower interest rates. And the story is that he threw the guy up against the wall and shoved him against the wall. And so this idea of Federal Reserve Chairman being independent is kind of silly. They work hand in glove with the Treasury Secretary, with the administration, to drive monetary and financial policy. And when we talk about Kevin Warsh, and they talk about him being a hawk, and this is something the media has been talking about, he's a hawk, that President Trump may be sorry that he nominated him because he's going to raise interest rates. But you got to understand, when we talk about Kevin Warsh, if you look at his track record, it's not a hawk in the sense that he wants higher interest rates, okay? He is a hawk in the sense that he's a budget hawk. He doesn't like government deficits. And this is something a little bit different than trying to control the economy through interest rates, which at this point in time, I don't think makes a lot of sense. I don't think we can control things a whole lot with the short-term interest rates. And so being a budget hawk means that Congress is not going to like Kevin Warsh because he's going to try to rein in congressional spending and government spending. This is a good thing. There's nothing wrong with this. We would like a smaller budget. And if you look at some of the things that Kevin Warsh has said, he really likes to grow the economy through efficiency, through smaller government, less spending, through technological innovation. So these are all the things that he talks about as far as being a hawk. It's a budget hawk, not necessarily an interest rate hawk. Now, what's been going on behind the scenes that has not been big news, but it is a big deal, and this is where there's a little bit of important things that are happening that maybe the CNN or the mainstream media doesn't cover, is what's going on in the currency markets behind the scenes. And this involves what is happening in Japan. The yen is clearly in a lot of trouble. The Japanese central bank's in a lot of trouble. And it looks like the Federal Reserve actually came in and bailed out the yen. It looks like we had some foreign currency intervention by the Fed. And so this is a big deal. I mean, when you don't have foreign currency intervention unless there's a real problem. And so seeing that manipulation in the currency markets obviously has had a big impact. We've seen gold prices scream up. We've seen silver prices scream up. And of course, I think that, we saw these big $5,500 gold and all of a sudden it crashes down to $4,500 and now it's back up to $4,800. And of course you had silver up to almost $117 an ounce, and of course it crashed back down to 75 and we're back up to like 88 now. And so we've seen these big up and down moves. And I think a lot of this is manipulation. I don't think this is a true market. I think the market's trying to get to a nice market level, but I think that a lot of this is manipulation. You're seeing a big breakdown in the charts on silver, for example, and it's amazing how there was these short positions that all the big banks held. Silver price kind of got out of hand, and all of a sudden there's like this coordinated effort. Silver prices crash down to $75, and it just so happens that JP Morgan gets out of all of their short positions at the perfect spot before it rallies back up. So I don't think that's a coincidence. I think that was planned, and who knows if it ever comes out. I think there's a good chance there's probably a lot of people in power, congressmen and the Trump administration, and who knows who else, all their friends. They probably knew in advance what was going on. They probably traded it and probably made a lot of money on it. And this is what we've seen with a lot of congressmen and senators with some of their stock portfolios. I mean, Nancy Pelosi, for example, she's outperforming Warren Buffett. She's phenomenal. She's the best stock trader ever. Well, I think there's a lot of government information that she's trading on, and I think that is probably what you saw recently in the gold and silver markets. Now, I do think that there's a lot of damage that was done to the charts in both gold and silver. So you've seen this big run up, and we made a lot of money on it. You've seen this big drop and then another bounce from there. Well, it came down to the 51-day moving average and bounced right off of that. So it's a very good spot. That's what we would expect. But at this point, I would probably see a lot of consolidation. That's my expectation. I think the market's going to consolidate. I think it will trend up. I think it's a good chance that silver prices are going to go back to $100 an ounce. I think there's a good chance that gold prices go back above $5,000 an ounce. But I think there'll be a consolidation period where you see these ups and downs, and it'll kind of consolidate for a while. I don't know how long, but it'll consolidate for a while before we have another big move up. So we want to participate in that. Just be patient. I don't think it's going to happen as quick as people think. We saw that big move already. And of course, we're still way up on all those accounts. We're very heavy in gold, very heavy in silver, in all of those investments. One note that's interesting on the Gradient Precious Metals Fund that a lot of our clients are in, they happen to sell their silver sleeve, which is about 25% of the position, at $109 silver. So in the next day, it just completely dropped. So that was a little bit lucky, but it was exciting to see, and it ended up being a very, very good result for our clients. So we were able to capture a lot of those returns and not give away some of the gains on the downside when it did come back down. So it worked out very, very well. And of course, the Copley Tactical Fund has a lot of miners in it. And I think these are super cheap. It's a great place to be right now. These miners are just trading at unbelievably low valuations. In fact, the price of the stocks have gone way up, and they're even cheaper. The stocks are even cheaper on a fundamental basis now than they were after they were half price. Now, how can that be? It's because the price of gold and silver has gone up so much that these companies are going to be minting money. You're going to see blowout earnings reports. All these gold mining companies, silver mining companies, they're going to have blowout earnings. And if you look at what the analysts are estimating on these particular gold and silver, they're assuming gold prices are going to be around $3,800 an ounce. They're assuming silver is going to be around $42 an ounce. We're already way above that. So even if the price drops to those levels, we're going to come in line with earnings estimates. Well, I expect those to be much higher. I expect a consolidation period at current levels, and I think we're going to see some really good earnings reports. So if you're interested in the Copley Tactical Fund, reach out to us because it's a great time to invest. We've got nice positions in some of the gold miners in there. And in addition to that, I think there's some great opportunities, especially in energy. What we saw with energy is when Trump came into office, you saw a lot of the red tape being cut. You saw a lot of permits being issued. And so naturally, you had a much bigger supply of oil and natural gas come onto the market, which drove prices down. And so we're seeing the result of that. Oil and gas prices are down quite a bit from what they were, 2 years ago, 3 years ago. Well, now I think that's over. I think the next move is going to be up. I think we can buy a lot of those energy companies very, very cheap right now. If the price of oil goes back up, which I think is a high probability, we're going to ultimately make some good returns on those investments. Now, why would oil and gas prices go up from here? Well, you got a big demand coming. This data centers, all the AI technology, there's a lot of demand for energy. There's just simply not enough energy to provide what they want as far as for these data centers and all the artificial intelligence. So now's the time to get into energy. I think it's a huge opportunity. I think there's a lot of opportunity as well in the small and mid-cap companies that are out there. These are companies that are benefiting right here in the U.S. Obviously, the trade deficit has come in shrinking better than expected. So these companies are going to make money. When you have these tariffs in place, these small and mid-cap companies are going to benefit from that. And it was interesting. I actually did a bunch of analysis, and I was looking for the best. They're called SMID funds, and I was looking for the best one. I found a good company called Congress, and we started working with them. And they're great. They have a good long track record in this category, so we were repositioning some people. And then, of course, I ended up going to the Gradient Conference in January last month, and they said, our analysis is that the SMID market is going to do really well, and we've got a new fund that's coming out. And it just so happens they're bringing in Brian Belsky, who's one of the top stock pickers. This guy's fantastic. He was with BMO Capital, and he's going to be the one picking the actual stocks, the individual holdings inside that SMID fund. So super happy to have that. So I think that's a huge opportunity. In addition to that, we've got the energy sector fund with Gradient, which outperformed the XLE last year. So great performance. So gives us an opportunity to reposition some of our clients in some of those energy names, just pure energy. So between all of those, we're very, very excited about what we see going forward. And of course, one way to invest in the stock market, one way to make sure that we continue to go up if the market goes up from here, and also protect ourselves in the event the market goes down, is to go into our buffered index portfolios, our BIPs. These have been tremendously successful investments for our clients, and we have the new pricing. I had to twist some arms to get everything today, so we finally got all the pricing, so I was able to record this. But we have the new 2-year buffered index portfolio has a 19.3% cap. Has a 20% dual directional insurance policy on it. So great policy for 2 years. It's a nice structured note that goes up to 19.3% on the S&P 500. If the market's up 15, you're up 15. If the market's up 19, you're up 19. But if the market's up 25%, you just max out at 19.3%. But in exchange for giving up everything above 19.3, we're able to have a dual directional 20% insurance policy. So that means if the market goes down, not only do you not lose, you make money on the way down, all the way down to minus 20%. So if the market's down 15%, you actually make 15%, which is a great place to be. Of course, it does have a maximum 20% reimbursement. So if the market was, say, down 25%, you'd get reimbursed 20%, you'd still be down 5%. So it's a good product to help protect us on the way down and also allow us to continue to make some money on the way up. Now, in the event you want to have a little bit higher potential return, we do have another version version of that has a 27% cap. It's actually a 27.6% cap. And that one is the lesser of the S&P 500 or the Dow. So if one of them's up 20%, one of them's up 25%, you're going to be up 20%. But that does give you an opportunity to make a little bit more money because it has a higher cap. Now that one does have a 30% insurance policy, but no dual directional. So in the event the market's down 10%, you just get reimbursed. There is no 10% gain like you have on the dual directional, but it does have a 30% insurance protection. So if the market was down 30%, you don't lose. You get right back to where you're at. So that insurance policy is very strong on that product. And then of course the one that I'm super excited about is the 5-year barrier. We have a 193% participation rate. This is the first time in I don't know how many months we broke the 190% level. We are at 193% of the S&P 500 futures index for the next 5 years. Very, very strong investment. If the market's up 50%, you're going to be up over 90%. If the market's up 100%, you're going to be up 193%. It is a 5-year hold, but it's a great way to beat the S&P 500. It's a great way to outperform the stock market. So those are all available right now. And of course, if you say, Matt, I just want no risk, I want guarantees, I want the highest return possible, but I want it totally insured, we do have a 3-year at 5.5%. Those are California numbers. You get a slightly higher interest rate outside of California. You can call us and we'll tell you what those numbers are if you are outside of California. But here in California, it is 5.5% on a 3-year, and it's 5.8% on a 5-year. Now it's interesting that 5-year product does also offer a 7 or a 10-year option, also at 5.8%. Now you might say, why would I lock up my money for 7 or 10 years if I only have to lock it up for 5 and I get the same 5.8%? It's because they guarantee that rate for the full term. So in the event interest rates were lower in 5 years, you still get to continue to collect 5.8%. And you start thinking about it, if you look at retirement accounts, you look at like Monte Carlo models and different, they say, you should just take 4 or 5% of your portfolio, and you have a 90 some odd percent probability of not running out of money. Well, you can take 5.8% and 100% guaranteed you're not going to run out of money because it's insured, right? So this is a great way to lock in guaranteed interest. And it may sound like a small number. We've been getting these big returns. The Copley Tactical Fund's up 33%. Oh, this is that. All these big returns, all this stuff. Okay. You don't know what's going to happen tomorrow. We don't know what's going to happen in the markets. We don't know if the market's going to have a big downturn. We don't know if a recession's coming. We don't know if some big geopolitical event's going to happen in the world that causes the markets to crash. So it's not a bad idea to lock in some guaranteed interest. So having a nice balance in what you're doing, I think, is important. And obviously this depends on your own individual situation. For someone who's younger, who can stomach the ups and downs of the market, we can be more aggressive. For someone who's maybe farther along in retirement, hey, that 5.8% is a nice way to make sure we don't lose any of our principal. So we certainly will work with you individually, one-on-one. We obviously create custom financial plans, which most of you know, but if anyone is listening and would like us to put together a custom plan, diversify everything in the right spots, feel free to reach out. We can work with you. Our financial advisors are experts at putting together these retirement plans that allow you to diversify everything, have a little bit of safe money, a little bit of buffered money, and then let's pedal to the metal, make some high returns. And so create a nice balance with everything that we're doing. But we're excited about what we see in the economy, assuming that valuations don't trip us up. And so we certainly want to take advantage of the fact that we've got some decent interest rates that we can go into. And I am concerned about inflation. So be very, very, I know there's a lot of positive stuff here as far as what we're seeing in the economic data, but we're still running big government deficits. We still have this quantitative easing. I think prices on everything are going to go up. So you want to be invested, and it doesn't matter what you're invested in. Just don't have your money sitting, not doing a whole lot. Don't have it in the bank making low amounts. Put it in something. You at least get that 5.8%, or at least put it into the buffered index with some protection, or at least put it into some good investments. And with some of the stuff we have, the energy sector fund, the SMID fund, the Copley Tactical, we've got the Alpine Capital Research. A great, nice, large cap value fund, up 30%. This is a fantastic investment, and they've got a great track record in times exactly like this, looking back in history. So thank you all. I hope this was a good market update. I look forward to seeing our office very, very soon.